Accounting equation and Excel. Sales receipt form. Data input form used when payment is received at the point of sale, such as in a cash register situation. Get ready and some coffee because we're getting to the accounting foundation, the accounting equation with Excel. All right, first, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Trust Me, I'm an Accountant product line. Yeah, it's paramount that you let people know that you're an accountant. Because apparently we're among the only ones equipped with the number crunching skills to answer society's current deep, complex, and nuanced questions. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. In Excel, if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go from here, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 3 tabs down below: example, practice blank, example, in essence, the answer key. The practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The blank tab, the one we will be working on, is where we started with a blank worksheet but are basically working within a template at this point. However, adding to that template as needed as we go. Let's go to the example tab to get an idea of what we will be doing this time around. Quick recap of what we have done. We started off using our accounting equation as a type of trial balance, the accounts that we will be populating in order to then create our financial statements from. We put in our beginning balances, imagining that we had a prior accounting system and we wanted to pull in those beginning balances using our current system with the accounting equation. We then put in the common first type of transactions often to happen with a new business, that being the generation of some kind of capital needed for the startup costs, need cash in other words, which would come from the owner or from a loan. Once we had that cash, we then did the next typical thing for a startup business. We bought investments in property, plant, and equipment, as well as inventory. And now we're into a situation where we're finally making sales. So in a prior presentation, we talked about the sale of inventory on account, meaning accounts receivable going up. This time we're going to have a sale of inventory again, imagining it's at basically a cash register type of situation. So we don't have accounts receivable going up, but we still have the impact on the subledger. Now, we're going to see the whole thing kind of mapped out from an accounting equation standpoint and that calculation of the subledger. This would be similar to if you were to go to a grocery store and you have your self-checkout, for example, and you scan the item. It's going to tell you everything you know on the sales side of things, meaning how much does the thing cost, unit cost, the number of units, total cost. It's going to give you the sales tax applied and how much you owe. What it does not give you is the tracking of the inventory that is tracked on the subsidiary ledger. However, the system, if set up properly, will have that information being populated on a perpetual inventory basis on the back end, typically using some kind of flow assumption such as weighted average or first in, first out. Now remember, when we learn this stuff, then the question is, if I'm doing bookkeeping clients or working in the accounting department of a business, where do I want to be specializing in? Inventory is one of those items. Inventory itself, however, will differ depending on the type of industry that we are in. If we just do our own selling, we make stuff and we sell things, then maybe we can track the inventory fairly easily within the accounting system on a perpetual inventory system, or possibly we do it outside in Excel or something like that, adjusting the inventory periodically based on a physical count within the inventory system. Once I have more complex inventory, then I might be using like an online sale of inventory at like a website, Shopify store or something, in which case it might be duplicating or not necessary to track every unit of inventory, both in my software as well as in the external Shopify software. So in QuickBooks and the external software. Therefore, I might track it in the Shopify store because I'm trying to track the units in order to sell them to keep up with the sales process, and then adjust again periodically in, say, my accounting system based on the physical count that I'm pulling in from like my Shopify store or something like that. Or if you have a cash register type of situation, you have a similar kind of question. Do I want to try to link my cash register like a grocery store would to my accounting system, having it record the inventory decrease and related cost of goods sold at the point of sale, which means you're going to have a lot more time on the setup process and the maintenance to making sure that that process is set up properly? Or you can say, I'm going to just sell things, record the sales side of the transaction, and then count the units that still remain nightly, weekly, monthly, and then do, based on that physical count, make a periodic adjustment of my inventory into the accounting system. So these are just options we have to keep in mind whenever we deal with inventory. Remembering you could specialize in many of these areas in accounting, becoming an expert in the current technology around inventory specifically, or you can say, I'm not a specialist in that area. I don't want to deal with that inventory stuff in that particular way because I specialize in something else, such as trying to get businesses in play that I can basically automate as much as possible. Inventory often messing up the automation process in terms of like bank feeds, for example. All right, let's go to the blank tab and see what this looks like. So we're going to be down here. We're going to say this is going to be another 119. The transaction, we're going to sell inventory at like a cash register, let's say. And then the inventory items, we're going to say is an ELP. Let's say we sell 3 of those. And then we're going to say sell a GSB and we sell 1 of those. Now notice this is similar layout to what we did up here when we sold inventory on account, except when we sold them on account, I also needed the customer because I need to track the invoice, which increases accounts receivable that we're going to get paid in the future. A sales receipt form we're imagining is basically the form that we would have at a cash register, for example, in which case I might not even know that, I don't need to know the name of the person necessarily. So in other words, if you check something out at like a grocery store and you do a self-checkout, they don't even know who you are. It might be nice to get the name of the people so that you can basically put them on your mailing list or something like that. But you don't need it to record the transaction typically. Whereas in accounts receivable, of course you do, because you need to follow up on that transaction. Also note that you could think of this data input form as like the receipt that you would get if you were to check something out at like a grocery store and you get a receipt. But in some cases, you might not have a receipt because it might be something that was an electronic transfer and you made the sale like online on a website or something like that, in which case you might not be providing this form externally. You might give them a thank you letter or something as a response email, but this particular form is not always one that we would give to the client, as is the case with an invoice form. So we have to keep the difference of what does a form mean to us. It used to mean that it would be the physical document. You can think of it as the physical document, like the invoice that we would give to someone or the receipt. However, from a data input standpoint, we're thinking of the form as the data input form. It's the form that we're going to use to do the data input. And when I drill down and have an audit trail, it's the data input form that I'm going to get to as the thing that caused the journal entry. So a sales receipt form, therefore, is one that's not going to increase the accounts receivable. That's an invoice, but rather it's going to go into a form of payment at the point in time that we made the sale. That's going to either go into the checking account if it's some kind of electronic transfer that we got, but more likely we're probably going to need this undeposited funds account, because if you're at a cash register it's likely that you're going to get payments that are going to be not direct feeds to your checking account. In other words, they're going to pay you with credit cards. They're going to pay you possibly with cash. And in those cases, the sales that we have are not going to go directly into our checking account, but rather into some third-party account, like a credit card, or into our cash register. Then we're going to deposit into our checking account with one lump sum deposit, meaning I need to put it into my checking account in the way it's going to show up on the bank statement. Otherwise, I won't be able to do the bank reconciliation, and it'll mess up my bank feeds if I'm trying to use my bank feeds in the same process. So if we're at this point of sale situation, it's very likely that we're going to have to use some kind of clearing account so that we get the matching properly allocated. This is something that you do not often see in textbooks. They often skip that critical component because they're just going to say you're going to get cash. Cash is going to go up, which is correct from a financial statement standpoint, but from a more refined bookkeeping system, you need to make sure that you get the cash going into your checking account that matches what's going to be on the bank statement, because the bank reconciliation is going to be a key component for any type of business of internal controls. All right, so we're going to say the ELPs, we sell them for $500, and we sell the GSBs, we sell them for $777. That's not the cost to us, that's the sales price. We're going to record it on a perpetual inventory system. Although these two things happened at the same time, you can imagine they come up to the check cash register with these two guitars or these three ELPs and one of these GSBs, but we're going to put them in line item by line item based on the inventory unit. So this time, instead of accounts receivable going up, we're going to say it's going to be equal to 500 units in undeposited funds times 3 guitars. I'm also going to say the sales tax still applies at the 5%, which we saw before. So that would come out to 1,500, but I also have to collect 5% sales tax. Easy way to calculate that is times 1.05, 100% of what we had plus 5%, giving us 105% of it, 1,575. The sales side is going to be recorded at the same time over here. This is going to be equal to, on the sales side, the 500 times 3 guitars. So that's the 1,500. The difference is going into the sales tax that we have to collect and pay protection money so that the government can protect us, even though they don't. I think the government's even in on it with the crooks, man. 500 times 3 times 0.05. I think the government's actually, they go to the porch pirates themselves. The government's like, why don't you go in there and rob the store? If you take less than $500, then we won't even charge you. It'll be great. And then it's ridiculous, man. What am I paying for? What am I paying for with this, my protection money? I don't get no protection. I don't get no Okay, let it go. Let it go. That's just the way it is, man. I'm just going to put my zeros across the board. Okay, here we go. We're going to then let's put then the next side, the GSB, so undeposited funds. Now, I haven't recorded the inventory and cost of goods sold side yet. We'll do that in a second. I just want to say that this is the side of the transaction that you would see when you're like get the invoice, or I'm sorry, the sales receipt, like if you're at a grocery store and you get the receipt. This was what would show on the receipt, and then we're going to add the part you don't see, the inventory and the cost of goods sold. All right, so let's do this for this one, 777. We got one of those, so just times 1, and then I've got to take that whole thing and multiply it times the sales tax, which is 5%, so 100%, 100.05, 105%. That's 816 we need to collect on that one. The sales side of things is going to be equal to the 777 times 1, because we just have 1, 777. And then the sales tax is going to be equal to the 777 times 1, because we just held one of them, times 0.05, the 5%. So sales tax is there. So the 39 sales tax plus the 777 is what we need to collect. and get paid for on the 8/16. All right, let's put the zeros across the board on that one. Zeros across the board. And so here we go. Here we go. Dang, protection money. All they do is laugh at me when I get robbed. They just laugh at me. They're supposed to be, I'm paying you to stop them from robbing me, you son of a, anyway, crying out loud. I tell you, ain't no justice around here, man. I'm gonna put some underlines. Underlines. Okay. And so then, okay, so then now let's record the inventory side of things. So let's go to the view tab and let's unfreeze the panes. And then, by the way, if I copy the formula down, I should still be in balance. So formula's copied down, formula's copying down, formula's copied down. We're back in balance. All right. So now let's put this on the bottom so I can go up to my subledger, and I'm going to put my cursor right above it here and then go to the view tab and split the panes. So now I can see down here, and I'm going to go up top to the top bit. I'm going to scroll up top and then go over to my ELP. Let's go to the right till we get to my inventory. So here's my ELP. So here was the last balance here. This is equals to last balance. And now we're on 119. And this is going to be how many units? We sold -3 units. They cost $400. This is going to be -3 times 400. And then we'll say pull that to the right, -3. And this is 400. So this is going to be equal to -3 times 400. Put an underline under that. Home tab. Font group underline. Summing this up. 58 minus 3 is now 55 units left. They all cost $400. So this is going to be equal to 55 times 400. Boom. Brings the totals down. So that's that. So that is good. So I'm going to make this green so that I can then pull that over into my second half of the journal entry. Let's make it the lighter green. That's too dark, man. It's too dark. All right. Whatever. And then we need the GSP. Where's that one? Was that over here? No, that's not it. GSP. GSP. Is that a new one? No, it can't be. Donde. There it is. GSB, not a P. All right, so then we're going to say this is where we're at with that one. And this is going to be on 119. And we're going to sell -3 of those at a cost of $598. Multiplying that out, 3 times 598 gives us, if I make this a little bit wider. Okay, there's the cost. Let's pull that out into the ending inventory. Same thing, 3 times 598. This is going to be equal to this times this. That gives us the reduction. And then that leaves us with the sum. 10 minus 3 is 7. They still cost $598. Multiplying that out, 7 times 598. We still have 4,186 units here. And let's make this green. So we'll make this green. Okay, so now let's take that information and put it in and finish up our journal entry. So I'm going to go to the View tab. I'm going to go to Unsplit the Panes. And then I'm going to go to all the way to the right to the top in cell A4 and go to the window and freeze the pane so I can still see my headers. Scrolling down and adding the second half of our transaction, which is going to have 2 sides to it, so it should remain in balance. So on the inventory side, we sold 3 units. Then I'm going to find the cost. There's the sales price. The cost is going to be times, I'm going to find it by going all the way to the top, looking for the green item, and then all the way to the right, looking for that green item that we had that was $400. So the cost after I put that 400 should be 1200. There it is. And so boom, I need to make it negative though, because inventory is going down, negative. And then the cost of goods sold is going to be the same. So that means this is the side you don't see when you make the sale. You see the 1,500 minus the cost 1,200. The difference 300 is the actual impact on net income. Let's do the same for the next one, the GSB. The inventory is going to be equals, let's say negative this time. So it's not 777. I only bought one of them times, and then I'm looking for the other green one. I'm going all the way to the top, going to the right to pull my cost from the sub ledger over here. There it is. So the cost was 598. Now wait a second. I only sold one of those. Let's go back on over. I think I messed that one up. I'm going to go back on over to my worksheet because I said I sold 3 of them. I sold 3 of those. I only sold one of these, -1. All right, that should fix it. Okay, so that should be 598. Okay, let's go all the way back. 598. I know I'm moving around a lot here. There's a lot of movement. A lot of action is happening. I'm getting a headache. Okay, so that's going to be 598. Boom. Other side, inventory is also going to be 598. So we had the sales increased by 777 minus 598. Net income increased by 179, therefore. All right, and then we'll copy this down, bringing our balance down, bringing down the balance. And we'll just sum this up. Prior balance plus the current activity. Going to copy that across the board and see if we remain in balance, which we should. Pasting it just the formulas only. Pasting it just the formulas only. And then we're going to paste it with just the formulas only. All right, let's make this sales item a little bit larger here so I have enough room. Okay. So now, so we're still in, so let's copy this down, see what our ending balance is, copy that down, assets at 233,446, copy that down, liabilities 88,505, equity then 144,941. I'm going to put an underline under these 3, underline, boom. All right, let's do it one more time. That was good times. Let's do it one more time. This one will be easier though, because I'm going to say on 119, what if we just sold something at a cash register that wasn't inventory? Like you're at a restaurant or something like that. Or in our case, we gave guitar lessons or something. So they came in and we gave them a guitar lesson workshop and we got paid at the same time, at the same point in time. Well, then we don't have to deal with the inventory. That's a lot easier, isn't it? So the bookkeeping for a service business, typically a lot easier to deal with because you don't have to track the inventory as you would with that inventory system, which is a pain. So we're going to say sale of services items, service items at register. It's a lot more difficult for people to come in and rob you as well. So if you're living in one of those places where you pay protection money but they don't protect you for nothing, then you might go away from the inventory items and say, maybe I won't sell inventory because people keep stealing it. Maybe I'll maybe I'll just stick to the guitar lessons here. Hopefully they don't steal my actual one guitar so I can still do the lessons. See if people can still get to the store without their guitar getting robbed, you know. But anyway, we're gonna say that this is gonna be the 5180, and then the other side is just going to go into the service revenue. Boom, service revenue. So it's same revenue side, but we'll put it into service revenue. Okay, I don't have one yet. So I could put it into the same sales, but oftentimes if you have service income, you might call it something else. So I'm going to select the whole AC column, and then I'm going to insert, and it should insert something to the right. So we're going to right click and insert, and this is going to be service, let's say revenue. something like that. Service revenue first, and then versus sales. And let's make this a little bit larger so it fits. Okay, so that's going to be equal to, it's going up by 5180. All right, let's put some zeros across the board. Zeros across the board. Boom, boom, boom. All right. Here we go. Yo. Nice and simple. All right, and let's put some underlines underneath it. Underline. And let's put some underline. And let's put some underline. All right, and then we'll pull down the balance. Pulling down the balance equals the sum of these two. We'll copy that, paste it across, just the formulas only. The formulas only. And the formulas only. All right, so now let's pull down the balance. Let's pull it down. Pull this down. See if we're still in balance. So there's the activity. Oh no, not like that. Undo and pull it down. All right, so that transaction's in balance. And I didn't have to deal with sales tax because I'm imagining where we are at, and where I'm at, oftentimes we have the sales tax that's applicable to inventory items, but sometimes not applicable to service items. Again, that will be dependent upon your location as to when they're going to be applying the sales tax and when they don't apply the sales tax, and so on and so forth. Let's put some underlines here. Maybe it's because the inventory items, they try to pretend like they're going to protect you from people stealing it, so you pay the sales tax for the inventory items. But then when people steal stuff, they just point at you and laugh. They laugh in your face, and then they come and kick you in the gut just to laugh some more. But that's okay, whatever, dude. All right. Anyways, so that's going to be, let's see. I think that's it. So we have assets at the 238,626, the liabilities 88,505, equities at the 121. Remember that equity represents the book value of the company. So if I took assets minus liabilities, we would then get to the equity, but that equity, if I was to liquidate the company, isn't something that I could easily walk away from, because I would either have to sell the company for the equity in total, just sell everything, or I would have to liquidate the company, which means I'd have to cash my undeposited funds to put it into the checking account, which we will do shortly. Better do that, because if you got it in the cash register, again, this ain't a safe place, man. People come in, steal that right out of your register, and then the cops that are supposed to protect you laugh at you again. But anyway, then you got the receivables. We'd have to collect on that. We'd have to sell the inventory. We'd have to then cash in our short-term investments to get that money. We'd have to sell our furniture and fixture for at least the book value, which is the difference between these two. Then we would have the cash of the 238,626, which we can then pay off our liabilities, which include the accounts payable, the credit card, the sales tax that we owe, and the bank, the loan. And then we would have the cash then, and then we can basically liquidate at that point in time. So just it's useful sometimes to just think about the unwinding process of the business in a liquidation format to get a better sense of what that equity number kind of actually means. It's also useful to think about that because in practice, if you need to liquidate, you want to make sure that you do it in order, in particular if you're a partnership. Because if you start paying off the partner capital accounts before you pay off the liabilities, you're going to run out of money and it's going to be messy. So just keeping that in mind.